And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Robert Ballantyne, who's the chairman of Ballantyne that manages over $8 billion. And Robert, I want to say a big thank you, and I'm really looking forward to today's conversation.
Well, thank you, Adam, and I am as well.
So, Robert, I always like to begin. Can you please tell us your story and how you got to where you are today?
Well, I began my career as an old-fashioned stockbroker. Took me a few months to realize cold calling is a tough way to make a living. But I began my career with Merrill Lynch in Atlanta after completing their training program in New York. Uh, Frankly, I quickly determined that my primary job was to protect my clients from the predatory instincts of my employer. This was before the days of caller ID, and my dad, who was working on the institutional side at Merrill, was my mentor, my best friend, and we would talk once or twice a day. And I remember the advice he gave me when I first started was, son, worry about your client first and yourself second. And if you do, you'll have people knocking on your door in a few years wanting to do business with you. So I started at Merrill, and after 7 years at the age of 28, I had become the youngest vice president of the company's history. And along with my dad, in February of 1987, left and started an RIA because we came to the conclusion that getting paid commissions for investment advice was a conflict of interest. And that's not new today, but RIAs in the mid 80s weren't rare, but were certainly less prevalent than what we see today. February, when we started, 6 weeks later, my dad was diagnosed with prostate cancer, told he had a couple of years to live. That was not in our business plan, but nonetheless, he persevered, died a few years later, and by the late 90s, we had become the largest independently owned RIA in the South, managing over $4 billion of discretionary assets. And that's when a lot of the firms up north figured out there was money south of the Mason-Dixon line. And within about 2 years, Bessemer Trust, Wilmington Trust, Northern Trust, Goldman Sachs, and others came to Atlanta and wanted to buy local firms. And my partners and I decided that we would sell our company to Wilmington Trust, founded by the DuPont family in 1903. We did that in 2002. In 2004, I took over as CEO of their investment management business. We got to play a bigger game on a bigger field, managing about 40 billion of discretionary AUM. The financial crisis hit, and we all of a sudden decided that we thought we could do a better job for our client away from some of the constraints of a publicly traded organization. And so 15 years ago this month, we started over to build the kind of firm that we would hire to manage our own capital. And that's what we've done.
Wow, congratulations. What a remarkable story. Sorry for your loss of your father. I mean, it's a blessing and curse at the same time. It's very difficult, but wow, what a great way to take that and then build on it instead of having it control you. You use it as fuel to grow.
Well,
Love
it's a
that.
good example of how you never know what's going to happen with a business plan when you write it, and you kind of take what comes along.
Yeah, for sure. Okay, let's talk about your investment strategy, please, and your business.
Well, we believe that the essence of investment management is really more about managing risk than return. And the process that we've developed over the years is based on a quantitative approach to public markets, looking at valuation and momentum. So we're seeking two things really, which is an asset class cheap relative to the way that it's been priced historically? And is there money flowing there? We believe in index funds. We think it's very difficult to pick stocks. You've got a lot of well-educated analysts who all have their CFA charter, who all went to good schools that are trying to ferret out some nugget of predictive information that's going to give them insight as to a particular company's earnings today versus another company. So rather than trying to pick houses, we're trying to pick neighborhoods. And so
Mhm.
our process has really evolved over the last 25 years from uh, away from trying to focus on particular areas of the market to looking at asset classes, but within asset classes, do we want to tilt tactically towards growth versus value, or US versus domestic, or what are some factors like quality or dividends or other things that we might want to emphasize, and do that using index funds, because we believe there are two things investors can control, and that's fees and taxes, and everything else is a little bit difficult. And we try to get our clients to focus on relative value and momentum as we make decisions in public markets.
I love that. And how do you define relative value? I know value like beauty is in the eye of the beholder. So if you can help the audience educate them a little bit, please, we'd appreciate it.
Well, I think to me, relative value is, am I buying something at a fair price relative to what I'm getting in return? When we think about what are the returns we get from equity markets, well, we get the dividend yield, which typically is fairly predictable and generally tends to grow in line with the economy and the company's profitability. And then we get that future stream of earnings. The wild card, of course, is what people are willing to pay for those earnings, otherwise known as the PE multiple. And so we're looking for areas in markets where we think there is good relative value, but we want to confirm that where we think there's money flowing into the asset class. Because, Adam, as you know, things can be cheap for a long time, but if nobody's going to buy them, they don't sell.
Right. Right.
And conversely, as Isaac Newton proved centuries ago, objects in motion stay in motion. So we look at technology stocks in the late 90s or housing stocks in the mid 2000s, and these things continue to become more expensive. But as long as money was flowing into there, they move beyond relative value. So we're not trying to top tick every trade. We're looking for, is there value and is there confirmation that this is more than a short-term blip?
I love that. So let's talk about risk. You said investors can manage to or can control two things. I was wondering, is risk also a third thing they can control? Or please let us know how you handle risk and some mistakes you see people make with respect to risk management.
Well, I guess that would depend on how one defines risk. We tend to look at risk as permanent impairment of capital.
Okay.
And as a fellow investment professional, you know that timing markets can be very difficult. And therefore, for those clients who are spending from their portfolios, whether these are endowments or foundations that we're trying to manage towards a targeted distribution rate, or if it's an individual retiree spending out of the portfolio, we want to immunize at least 2 years worth of spending by keeping cash net of portfolio yield to fund that. So if your portfolio is generating 2% in dividends and interest and you're spending 4%, we're going to want to keep 2% for the first year and 2% for the second year in cash or short duration fixed income, so that if we hit an air pocket like we did in March of 2020, we're not having to pull from risk assets in order to fund spending. So that's one way that we do it. Another way that we do it is trying to understand really what the client's investment goals are, because I think so many in our industry try to manage towards beating a benchmark. We think it's important to manage towards beating the client's objectives. And that's why we are a large proponent of goals-based investing.
I love that. That's actually a really interesting way of playing the game, so to speak, because you're not doing what everyone else is doing. You're focused on the client, which was your dad's advice from way back when. Focus on the client.
He used to say, your clients are your capital.
I love it. I love it. I love it. All right. From a risk standpoint, before we move on, you said you invest in neighborhoods and you like momentum. Object in motion stays in motion. I like that a lot. And how do we know when the trend is over, so to speak, or the object is stopping in motion and then starting to go down? Do you use stops, or is it when that is there a valuation dividend versus earnings, or how do you know when to exit?
Well, the first thing we're trying to do is understand what should be the balance between equities and fixed income. And that's what we call our tier one model. So we're looking at the earnings yield on stocks versus what we can get in terms of the 10-year and other measures of valuation between equities and fixed income. And within fixed income, we're really looking at momentum. So we are measuring money flows. We're looking at whether these asset class are likely to persist. And if we can get it, as I said earlier, we're not trying to top ticket, but if we can get it after the trend is maybe 20% of the way, or it's down 20% of the way, we're happy to capture that spread in between, because I think if you've been in this business long enough, it teaches you humility, if nothing else.
Couldn't agree more.
And
Couldn't
and
agree
just
more.
when we exactly,
Yeah.
and just when you think you have it figured out, something happens. One of my heroes in this industry is Charlie Ellis, who founded Greenwich Associates, and he describes investing as a loser's game. And a loser's game is determined not by who makes the winning three-point shot or the winning field goal or that home run. It's by loss avoidance. It's like if you
Right.
and I, Adam, are playing tennis, all I have to do is just keep the ball in play and rely on you, my opponent, to make a mistake. So we are big fans of what Albert Einstein described as the eighth wonder of the world, compound interest. And he said those who understand it benefit from it, and those who don't pay it.
Mhm.
So if we can compound assets using lower volatility, we're going to create more wealth down the road than trying to knock the lights out when the market's going up and ride it all the way down when it's going down.
Yeah, no, I absolutely love that. So, okay, shifting the conversation just a little bit to some timeless lessons, advice, and pick your brain a little bit here based on your expertise and your experience. What are some timeless lessons, Robert, you've learned along the way that you'd like to share with the audience about investing, about business? I know you're very big on entrepreneurialism, buying and selling businesses. That's close to my heart as well. Anywhere you want to go with that.
Well, I think first of all, as it relates to investing, as I said earlier, focus on what you could control. Understand your appetite for risk, because countless smart people have written a lot about behavioral economics. And one of the challenges that we see for our client base, who tend to be business owners and entrepreneurs, is when they've monetized their life's work and it's sitting in a piggy bank and it looks like a number at 4 o'clock at the end of the day when all public market assets are marked to market. The behavioral bias to react to what's happening short term is very real. You typically don't see a valuation outside of your company where it's flashing a price at the end of the close of the market each day. So educating people about taking a longer term perspective and realizing that investing is a marathon, it's not a 100-yard dash, and understanding and immunizing your own behavioral biases. I think from a planning standpoint, one of the lessons I've learned is how important it is to bring your family into discussions, particularly spouses, and to seek alignment. And for our clients, where the typical client has north of $20 million with us, these families have generational capital. And
Mhm.
teaching their children how to be good stewards of this capital, and how do you raise children in families of affluence without depriving them of the joy that comes from earning a living or spoiling them,
Right.
and having everything grounded in values is so important. I've been in this business a long time and I've watched it shift from in the 80s, picking stocks and bonds, to financial planning in the 90s and tax planning and estate planning all through the 2000s. And I think now, on the eve of the greatest intergenerational wealth transfer in history, families are asking questions about, who am I besides my money? And what is my
Right.
legacy? And how do
Right.
I want to use these assets with which I've been blessed to help my family and help my community philanthropically?
Yeah, that's so powerful. And then how about the other side of that, timeless mistakes?
Well, I think timeless mistakes are A, trying to time the market, B, believing that strategies that you don't understand, which typically have long lockups and high fees and very um, confused documentation around things, or things to avoid. I have watched wirehouses for years package things together through structured notes and other complex derivatives, where I can get the same notional exposure without all of the costs, or where I'm looking at things that might have a little bit more risk associated through leverage than what I was led to believe. So I
Okay.
think investing or avoiding those mistakes by focusing on plain, simple things that you understand, not just that your advisor understands, is going to go a long way to avoiding some of those mistakes when it comes to investing.
I love that. So basically, it's not getting caught up in the crowd. It's not following with blinders on. It's not even getting caught up with the day-to-day action because you mentioned before, most days don't matter. At 4 o'clock, you get, nervous or get worried about your emotions take over, which is very much aligned with my world. So I love that, just zooming out and saying, hey, am I on my right path? Am I getting towards my goals? So on and so forth, and not getting caught up with the day-to-day noise. Is that a good way of
Exactly.
summarizing it? Yeah.
And trying to avoid listening to pundits who are trying to get us to take investment action every time the market moves. I kind of chuckle sometimes when I watch Jim Cramer and other pundits tell us what to do long term versus when I look at their actual investment results.
Yeah, no, there's no question. If you take a deep dive into there, it's amazing. It's like the Wizard of Oz type of a thing, right?
Right, right,
Yeah,
right.
all right. So let's talk about your entrepreneurial spirit because that's dear to my heart, if you don't mind. And I'd like to know a little bit about that. What is it that you do there? What if project? I know you bought and sold your own business several times, and can you just educate the audience on entrepreneurialism, please?
Well, only in America can one be an entrepreneur and have the opportunity before us that we do. And I guess in my heart, I love working with entrepreneurial clients because they understand what it's like to take risk and they understand what it's like to work hard. There's an old African proverb that says, if you want to go fast, go alone. But if you want to go far, go together. And one of the
Mhm.
things that I've realized is you can go a lot farther if you've got a team that is aligned, that are all working together for a higher purpose.
Mhm.
And helping our clients is really a noble calling when you are in the position of being trusted by somebody to look after their money and you know their family. It is a profound responsibility. And I think as a servant leader, which I've always attempted to be, standing at the back of the line and placing employees first, they're going to take care of your clients. There's a school of thought that says, look after your clients first. I have a different thought. I think if you look after your employees and your team member first, and you can create a work environment where motivated people flourish, you're going to have those people take care of your clients, and the clients ultimately are going to reward the shareholders. So, what
Mhm.
I have perhaps realized most in my entrepreneurial journey is the role that team members play and the importance of getting people aligned and creating a culture where people are motivated and want to come to work. Because at the end of the day, you're going to spend more time during waking hours with your work colleagues than you are your family. So you
Right.
might as well get along with them and you might as well enjoy one another and create a collegial culture where people feel like they can be their best selves.
I love that. Yeah, that is so, so powerful because you're still taking care of the clients. Clients are your capital, but you yourself can't talk to all of the clients. So you have to have team members. And if you instill those principles in them, that's a butterfly or the multiplier effect where you can just reach such a massive, 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 do more good and take care of more clients, is what you're saying ultimately, correct?
Exactly.
Yeah. So, okay, we spoke about leadership. Next question, adversity. How do you handle adversity and what are some obstacles you had to overcome along the way? Because I know every great leader deals with adversity in their own way. So I'm interested to see what you have to say, please.
Well, I guess the first opportunity I had to deal with adversity, as I mentioned earlier, was losing my dad because we had started our company together. We were best friends. We were 50-50 business partners. But he taught me a lot about how to deal with adversity. The fact that his doctor said he was going to have 2 years to live and he lived 7 years. He had 5 really good years, but
Hmm.
he came to work with a smile on his face. He didn't have a chip on his shoulder. He didn't sit there saying, woe is me. And I learned a lot about dealing with adversity, watching his battling with his health struggles. The other
Hmm.
thing is when we sold our first company to a publicly traded company, unfortunately, that company got caught up in the financial crisis.
Mhm.
and is one of the five senior executives that was asked to sign the application for the company's troubled asset relief funding. Um, I realized that even though the investment business was doing very well and had 40 billion of assets under management, the retail bank with a regional footprint took the company out. And it had very real economic consequences for me, having sold my company to this public company and gotten mostly stock in consideration. And
Mhm.
when you're a Form 4 officer of a publicly traded company and you can't sell except during certain window periods, and you're
Mhm.
watching that in free fall, it's pretty stressful. So as the company, which was trading on the New York Stock Exchange at about a $6 billion market cap, started in free fall 2 years after we left. It was sold over the weekend by the FDIC to M&T Bank out of Buffalo for less than $300 million.
Ouch.
So when you watch the dividend being eliminated, the equity in free fall, the options all underwater, and the fact that you were a party to the TARP funding, which capped executive compensation at a third, that was a super stressful period and taught me a lot about adversity. And that's when 17 of us left 15 years ago to start over. Because the one lesson I learned, Adam, is you can't change the culture of a company unless you're the leader.
Right. I love that. That is so powerful. So powerful. Wow. Okay, Robert, final question for you. What's the best piece of advice you'd like to give the audience or your 30-year-old self?
Well, I think understanding some of the timeless fundamentals about investing, the miracle, as I alluded to earlier, of dollar cost averaging or of compound interest, the rationale for dollar cost averaging, the idea that getting rich quick is generally the stuff of which fairy tales are written, and that it takes disciplined, hard work and a long-term view. We've all seen the charts of reasons not to buy equities over the last
Right.
100 years, where we've had wars and we've had depressions and we've had economic crises and recessions. But if you are investing in the US economy with a diversified basket of businesses, the chances are you're going to do really well, and focusing on those things that you can control and not being lured into whatever the latest and greatest fad is. Those are kind of the building blocks for long-term financial stability.
I absolutely love it. Well, Robert, thank you so much for taking the time to speak today. Hopefully, we'll have you on again soon. And that's been an absolute pleasure.
Thank you for having me, Adam.